Hello, and welcome back to our channel. Today we're diving into a topic that's crucial for anyone looking to maximize their investment returns. It's investing for after-tax returns. So we all know taxes can play a significant role in eroding your investment gains. So understanding how to manage them is essential. So let's explore strategies to help you keep more of what you earn. But first, hi, my name is Kurt. I'm a certified financial planner, and welcome to the channel where we explore money and meaning. So first, let's clarify what we mean by after-tax returns. So simply put, it's not how much you make, it's how much you keep. And while many people like to focus on their pre-tax return, the after-tax perspective provides a more accurate picture of your investment's real value. Taxes can be a substantial drag on your investment performance. For instance, interest income from taxable bonds. That's taxed at your ordinary income rate. So you could be paying as much as 37% in taxes at the federal level, plus any state taxes that are applicable. Similarly, any short-term capital gains on assets that you hold for under a year are also taxed at these same higher ordinary tax rates, while long-term capital gains enjoys lower rates. So you can see pretty quickly, it makes sense to be thoughtful about how you think about the net gain that you're looking at from your investments. One really effective approach to enhance after-tax returns is called the first fill strategy. This method really emphasizes the importance of asset location, strategically placing investments in accounts that offer the most tax advantages for that asset class. So here's how it could work. Number one, you want to put bonds in a tax-deferred account. So you allocate taxable bonds, corporate bonds, which could be high yield or corporates, as well as U.S. government bonds to tax-deferred accounts like traditional IRAs or 401ks. This allows the interest to grow tax-free until withdrawal, potentially at a lower tax rate. Number two, active mutual funds, you want to have those in tax-deferred or tax-free accounts. Since actively managed mutual funds often have higher turnover, which leads to more taxable events each year, holding them in tax-deferred or tax-free account can shield you from those immediate tax liabilities. And number three, think about putting equities in taxable accounts, particularly with your buy and hold equities or ETFs. And generally, ETFs are going to be more tax efficient than mutual funds just due to their structure. So this can help minimize capital gains distributions. There's also products like direct index products that can offer even more tax efficiency. Another powerful tool in your tax management arsenal is tax loss harvesting. This involves selling investments at a loss to offset investment gains elsewhere in your portfolio. Thereby, you're reducing the effect of the capital gains in your taxable portfolio. The key is to reinvest the proceeds into similar but not substantially identical investments to maintain your optimal asset allocation without violating IRS wash sale rules. Next, you also have to think about choosing the right investment vehicle. So the type of investment vehicle you choose also impacts your tax efficiency. ETFs versus mutual funds, for example. ETFs often have a tax advantage over mutual funds due to their structure. They're taxed more like an individual stock, which means you only pay capital gains when you sell. Mutual funds, however, are required to pay their internal capital gains each year. And sometimes it's nothing. Sometimes it can be pretty meaningful. So if you have the choice between a mutual fund and an ETF, we tend to prefer the ETF. And if you're a high net worth person, which is usually defined as someone with $1 million or more in investable assets, you need to know about separately managed accounts, or SMAs. SMAs offer personalized portfolios, meaning you own all of the individual stocks in a given strategy, but it also includes benefits like active tax management, customized tax loss harvesting, and in-kind transfers, which are all things that help reduce taxes. And then within the SMA category is another subset called direct indexing. Now, most SMAs are actively managed, which means a portfolio manager is trying to outperform a certain index, where a direct SMA or direct index SMA is a passive investment, which means it's trying to replicate a benchmark like the S&P 500, but it will swap out stocks with losses and create a bank of capital losses over time that you can eventually match against capital gains elsewhere in your portfolio. The minimum for these products is often pretty high, but those are coming down with the advent of fractional shares. But if it makes sense, they can save a boatload in taxes over your lifetime. So, investing for after tax returns requires a strategic approach that considers both asset location and the types of investment vehicles that you use. So, by implementing strategies like the fill first approach, tax loss harvesting, and using more tax efficient product vehicles, you can enhance your portfolio's tax efficiency and keep more of your hard earned money. And if you want to learn more about aligning your money and your meaning, hit the subscribe button. Thanks for watching. See you next time.